Hi, my name is Ihab Dalwai. I'm a senior fund manager at ICICI Prudential Mutual Fund. Tariff announcements have dominated the market headlines over the last 3 months. And back home in India, with the additional 25% tariff, over and above the 25 earlier imposed, India is now facing one of the highest tariffs, similar to countries such as China and also Brazil. Surely this can be used as a negotiation tool by US, and these rates can come down, as we have seen in earlier interactions of US with other countries as well. But as things stand today, it puts India at a disadvantage versus other nations as far as exports to US are concerned. Though as a percentage of India's exports to US, it doesn't seem high, but it's important to note that sectors such as gems and jewelry, textile, leather, these are labor intensive sectors and does do impact our job market if volumes or revenues come down in these sectors. However, key export sectors such as pharmaceuticals and auto components are taxed at 0 or lower tariffs. In the entire scheme of things, it is important to note that service exports remains outside the purview of tariff discussion. And India's IT sector competitive advantage is not only limited to the cost effectiveness, but also to the large-scale English-speaking engineering talent pool which it offers. When it comes to the Indian equity market, I feel that we are in a low to moderate return, range-bound market. The reason I say so is that downside is limited because India's macroeconomic stability is at one of its best. And by this, I mean that when we see the data, we have one of the lowest inflation, forex reserves are very high, current account deficit is stable, government balance sheet is quite strong, corporate balance sheet is strong. So as a result of which, I feel downside in Indian equity market is limited. But however, for the upside, earnings growth has to accelerate. And this has been weak since financial year 24. Till financial year 24, we had seen strong earnings growth, primarily led by margin expansion in corporate India. But over the last 4 to 5 years, the scope of margin expansion is limited. Hence, earnings growth has been tracking revenue growth. Though we see pockets of growth in sectors such as housing, PLI-led manufacturing, broad-based growth has been weak because of slower consumption. However, I feel within a couple of quarters, consumption should pick up. And as a result of which, I like consumption as a theme or a sector, and within that, discretionary consumption is something one can bet on. But given the market outlook of moderate return, range-bound market, I think it's best to invest in a dynamically managed asset allocation scheme such as multi-asset fund. What does this fund do? This fund invests in assets such as equity, debt, commodities such as gold, silver, and also in REIT InvIT. The advantage of this fund is that it's highly flexible. It can maneuver across these asset classes. And as and when an asset class does well, it can book profits, switch to the other asset class, and can keep moving amongst these asset classes. And as a result of which, because of this flexibility, I feel the volatility of return of the end product is lower, primarily because of the continuous shifting between the asset classes and also because of asset diversification. To summarize, because of the market outlook, I feel the multi-asset fund is the right fund to invest in. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.